Well, good morning and welcome to the Global View, where we look for ways for investors to make money beyond the ASX listed universe. I'm Nadine Blaney. Great to be here with you. Well, trepidation ahead of the US inflation report led to a mixed finish on Wall Street. A fall in shares of the big banks weighed on sentiment. And we did have strength, though, in some of the big tech, those old FANG names, pushing the NASDAQ higher. Energy stocks were especially weak as Brent closed below $70, down 3.5% for ExxonMobil. Chevron hit a more than 2-year low. Occidental Petroleum was down to its lowest since April 2022, and Halliburton shed more than 1%. JP Morgan Chase shares also fell, down more than 5% after its president warned that earnings will fall from interest payments as rates are expected to ease. Meme stock poster child GameStop shares fell after it reported a drop in second quarter revenue, and Broadcom jumped 6%. KeyBank says that the latest Apple iPhone 16 AI-powered features will be positive for the company. So U.S. banks' capital requirements are changing, and last night the regulatory chief of the Federal Reserve, Michael Barr, outlined a plan to raise big banks' capital by 9%. So that is significantly less than an earlier proposal that was knocked back by Wall Street. But it did disappoint some of those asking for higher capital requirements. So it might actually become an issue if the administration changes. And on that, U.S. Republican Donald Trump and Democratic Vice President Kamala Harris will battle it out today, an hour into Australian trade, for their only scheduled debate of the U.S. presidential campaign. Otherwise, investors are keenly awaiting the U.S. consumer price inflation figures. It is the last major economic data point before the Fed Reserve's interest rate decision next week. The U.S. 10-year Treasury yields failed to hold earlier moves and fell about 3 bips to 3.67%. 2-year Treasury yields trading mildly higher. So let's get more on what we are expecting, and in particular from the Fed. Joining us now is John Blank from Zacks Investment Research. John, nice to see you again. It's been a very long time. I would like to get your thoughts, though, on this U.S. presidential debate. Will it change anything you think in terms of market sentiment?
Change the market sentiment? Absolutely not. It won't change anything. The two parties will appeal to their base, and the base in both cases is going to be very strident about what they see, regardless of what actually happens. So there's a small amount of undecided voters in the swing states that will perhaps be polled after the debate, and maybe that creates some kind of Wall Street motivation or change in sentiment. But it boils down to, at this point, 6 or 7 states and tens of thousands of voters in those states that are undecided.
Okay, so we will be keenly watching out for that in just over an hour's time. But the main game is the Fed, what the Fed will do come next week. And so there's a lot of, I guess, debate about 25 versus 50 basis points. Is that, in your mind, what we should be focused on?
No, Nadine, we should not be focused on what the Fed's going to do in September. CME Fed Fund futures, before I got on the show, I looked, they're 34% for 50 basis points and 2/3 for 25. And as an economist reading the, Chris Waller type speeches and Williams speeches from the New York Fed over the last week or two, there's almost no question they're going to do 25. And frankly, I'm a little surprised that Wall Street's trying for 50, because gradual rate cutting over the next year or two will be much more beneficial for stocks than a rapid rate cutting, simply because it will be signs that there is not distress and a hard landing coming. So I don't really understand why, when I look at the Fed Fund futures for December 2024, literally 3 months from now, 4 months from now, they're looking for 125 basis points of cuts this year, which means that is so strong and so out of an alignment with what I'm thinking as an economist, which I would say, they might do 25 in September, wait and pause in November and do another 25 in December. That would be my base case, barring a change in the data. So there is basically this huge amount of bias in the market for an extreme hard landing case that is going to either be right and a great prescient call, or it's going to be dead wrong. And that's really what we're going to be trading on for the next 3-4 months.
Okay, so talk to us then about some of the dynamics that would give us an idea of where interest rates are likely to head and whether this soft or hard landing will be achieved. And I would imagine that the ground zero now that the peak of inflation has passed would be jobs.
Jobs, yes and no. I mean, I look back at the annual decline in jobs. How much jobs were created in advance of a soft landing. And 94 was the last time we tried this, Nadine, and it was 1.5 million, which is basically 125,000 jobs a month. Which, by the way, last month we did 140 some thousand jobs, which is exactly in alignment with that. But more importantly, when you look out over a year, right now we're also at 1.5 million. So if you really think about it, the Fed modeling, which is based on this job stuff, is totally consistent with cutting the rates right now. That's the first thing I would tell you. The other thing I would tell you is their median projection for where they intend to get, not where the market thinks they're going to get, but where they intend to get in the last summary of economic projections, 2.8. So they themselves think they're going to get 9, 10, 11 cuts, but they're going to do it out all the way to 2026. So the thing I don't understand right now is I get it as an economist why they want to do that. And I get it as a stock market strategy because a slow rate cutting cycle is far more preferable than what the CME Fed Fund futures are saying. And people are screaming for 50 basis points as part of that. And frankly, that's the wrong answer for Wall Street, which is kind of fascinating.
Okay, so the 10-year real interest rate, I think we've got a chart that can show what you are looking at, is that you don't think that soft implies a smooth and gradual landing.
That's correct. So what we got here, Nadine, is we've got a move in real interest rates, which is when you take the Fed funds rate and you subtract out the inflation rate. So you get a move in the real interest rate when you lower inflation, like we're going to see tomorrow. It's plus 2%, 0.2% month on month. That's a 2.4% annualized. So you can see why the Fed wants to get to 2.8 terminal. They say, hey, if we get to 2% in our expectation for the Fed, for the CPI and the core PCE, then if we get 2%, we can get to 2.8, which is a 0.8 real funds rate. So right now we're at 1.6 on the real funds rate, which isn't much. But what you're seeing here is they're going to plan to cut and just kind of move along with the slope of the decline in the Fed fund rates, more or less, and then probably tack on another, 75 basis points on top of that. So that's the thing you want to pick up in this chart is if you look back into the 90s, they were at 3 and 4% real interest rates. And when we did a soft landing before, Nadine, we were at 6.6% unemployment. People are worried right now in the United States at 4.2%. So you've got to ask yourself, who is smarter? Alan Greenspan, who thought there was plenty of tightness and got it right at 6.6%, or all this hand-wringing going on right now with 4.2%, which is extremely low, historically speaking, and for certainly from the case of how we're going to get a shock through the jobs incomes channel to take the United States economy down. I simply don't get it. And again, I don't understand, other than there seems to be this inherent bias for people looking for a hard landing because of their confirmation bias in 2008 that we had one. But Nadine, the other thing I'll point out about hard landings is we have a 9% annual non-residential fixed investment growth rate in the second quarter. And that is not what was happening in 2006, 2007, 2008. People think, yeah, we were in a black swan, like it was a big event. We didn't know about it. Actually, not true. There was lots of signs for 2 years that fixed investment was falling apart. The total opposite is happening up here right now. Yeah. Home building is one of the strongest sectors right now. So we still got a disconnect here, like I said, about unwinding the hard and soft landing story. And frankly, I'm in the soft landing case.
Yeah, but I mean, is there also an inherent risk of a policy mistake insofar as, the Fed is not going to cut enough, or the Fed will cut too much considering some of the economic indicators out there, and that will lead to, overlending. It will lead to, subprime mortgage crisis, Mach 2. Obviously not with the same characteristics, but just, loosening things up or leaving things too loose.
We'll see. We'll see. This is why I personally think, why 25 basis points makes most sense in September to me, and then see what happens. See, this is the thing. I mean, everybody thinks they've got it all figured out how jobs are going to move with the interest rate, how the long rate's going to move with the interest rate. But we've already seen we get $67 barrel oil with 3.7 of the 10-year before the Fed even cuts because of what's going on in China. So again, there's all kinds of international implications. If, for example, in the ECB, they've already cut and they can't get their overnight rate down anyways. So there are so many kind of contradictory or unusual data events when you look into this that you say to yourself, there really isn't a prescient way to say, yeah, when I cut this much in this much time, it'll have that much effect on U.S. jobs in this cycle. I think that, basically is my problem with all the people, the prognosticators out there. I just think, like you pointed out, subprime in your language, that is a confirmation bias. That's 2008. That's certainly not going to happen. That's why we were talking about these capital reserve levels in the top of your show, is because the Fed's on it this time. They've got their stress tests in place. They're asking the banks to reserve up. So whether they did less or more, they're still on the right page of saying reserve up. And that's why the bank stocks sold off today. However, Nadine, the bank stocks have been leading the U.S. stock market in the S&P 500 this year.
Yeah.
So they sold off, but they're still very much the leader, over the last year. And that's also very much not a 2008 situation.
Yeah, same here in Australia. I'm just got an eye on the time. So quickly, we're investors. What's your approach to U.S. equities, John?
I still like tech. I think, you got to look at S&P 500 up 15% this year to date, and NASDAQ 13.5% at this low with this correction. And you got to like tech. You got to like, names that are, in the healthcare space. I threw out Intuitive Surgical to you, ISRG. This stock went up 3 times over the last year or so. You've got medical and technology stocks that are still going to play out really well. The big name stocks, the Amazon stocks, the Google stocks, all the other stocks that are out there, when they get pulled back, that's going to be a good news for investors. The other name I like right now is Pure Storage, which is a cloud-based chip company, flash chip company that most people know about. I just found out myself today. So, I mean, again, there's lots of names in computers and technology that I think on the pullback you've got to like, because it's still the number one from an earnings growth perspective right now in the S&P 500.
Got it. Thank you so much, John. Really appreciate it. Take care.
Bet.
All right, we will be watching this market very closely in about a minute when it gets underway. Looking for a slight lift upon the open. However, energy will be in focus. Well, the commodities complex in general could prove to be a weight on this market overall. So we will see. Stay with us. The open is next.